On February 26, 2022, just 2 days after Russia invaded Ukraine, the United States and the European Union made a decision that shook the foundations of the global financial system. They moved to cut Russia off from SWIFT. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, isn't a bank, doesn't hold money, and doesn't move money. It's the secure messaging network that connects more than 11,000 banks in over 200 countries. When a bank in New York sends $1 million to a bank in Tokyo, SWIFT is the nervous system that carries the message. This account is authorized to send this amount to that account. Every day, this network underpins roughly $5 trillion worth of transactions. If you're disconnected from SWIFT, you're not officially banned from the world economy, but practically it feels very close. Trade finance becomes difficult. Cross-border payments become slow, risky, or impossible. Your economy is pushed to the edges of the system. So when the West announced Russian banks would be cut off from SWIFT and $300 billion of Russian central bank reserves would be frozen, it was presented as the nuclear option of financial sanctions. Commentators said Russia's economy would be crippled. The ruble would collapse. Putin would either retreat or face political chaos at home. But that's not what happened. The initial shock was brutal. Yes, the ruble crashed. The Russian stock market shut down. ATMs ran out of cash as ordinary people panicked. Yet within months, the narrative began to shift. Russia stabilized its currency, redirected energy exports, and continued trading, just not through Western channels. The ruble recovered. The economy bent, but did not break. And something else happened, something far more important than Russia's short-term survival. Dozens of countries watched. They watched the United States and Europe demonstrate in real time that if you anger the West badly enough, your reserves can be frozen, your banks can be cut out of the payment system, and your access to the global financial network can be switched off, not for economic reasons, but for political reasons. And they asked themselves a simple question. If that can happen to Russia, why couldn't it happen to us? That question is now reshaping the global financial order, because this wasn't the first time a dominant power weaponized its financial system. In fact, if you zoom out over the last century, you see the same pattern repeat again and again. The dominant power controls the system. It weaponizes that system to punish enemies. Targets start building alternatives. Neutral countries quietly hedge their bets. And slowly, the original weapon loses its power. The empire thinks it's flexing its ultimate leverage. In reality, it's accelerating its own decline. To understand why SWIFT sanctions and dollar weaponization may mark the beginning of the end of American financial dominance, we need to look at that pattern historically, and then look at the data happening right now. Let's start with what SWIFT really is and why it matters so much. SWIFT was founded in 1973 by a group of 239 banks from 15 countries. Before SWIFT, global payments relied on telex machines, slow, insecure, and full of errors. SWIFT standardized the messages banks send each other, created a secure protocol, and turned cross-border payments into a fast, reliable, automated process. By the late 1970s, SWIFT processed millions of messages a year. By 2020, it was processing billions. Today, around 45 million messages move through SWIFT every single day. It became the default plumbing of international finance. And even though it's headquartered in Belgium and presents itself as neutral, SWIFT is tightly linked to the Western financial system. The majority of global trade still settles in U.S. dollars, and most of those dollar transactions move through banks in New York. The United States, through its legal jurisdiction over dollar clearing and its influence over SWIFT, can effectively decide who is in or out of the global financial network. This isn't a theoretical power. Washington has used it before. In 2012, the U.S. pressured SWIFT to disconnect Iranian banks because of Iran's nuclear program. The impact was devastating for Iran. Oil buyers couldn't easily pay, exports collapsed, inflation soared, Iran's economy shrank, and the pressure helped push Tehran to the negotiating table, which eventually led to the 2015 nuclear deal. On the surface, that looked like a success story. Use the financial system as a weapon, get the policy outcome you want. But underneath, something else was happening. Iran started building alternative channels, barter deals, non-dollar trade with Russia, China, and Turkey, and early experiments with cryptocurrencies. The first blow landed, the second one hurt far less. Now scale that up from Iran to Russia, a nuclear power, a major commodity exporter, and a much bigger piece of the global economy, and you begin to see the problem. When you weaponize the network against a small, isolated country, you scare that country. When you weaponize it against a major power, you scare everyone. And this is where the historical pattern kicks in. First example, Britain, World War I. Before 1914, the British pound was the world's reserve currency. London was the financial center of the planet. Around two-thirds of global reserves were held in sterling or in British institutions. International finance, even during wars, operated under an informal rule. You might fight on the battlefield, but contracts and deposits in London would be honored. When war broke out in 1914, that norm was shattered. Britain passed the Trading with the Enemy Act, which allowed it to freeze or seize German assets. German ships, businesses, bank accounts, and investments across the empire were grabbed or locked. Financial warfare had officially begun. In the short term, it hurt Germany badly. In the long term, it damaged trust in London. Neutral countries saw that reserves held in Britain were only safe as long as Britain approved of your government. They began diversifying. More gold, more accounts in New York and elsewhere, less reliance on the city of London. 30 years later, at Bretton Woods in 1944, the pound formally lost its reserve currency crown to the U.S. dollar. Britain had won the war militarily, but lost its undisputed financial throne. Weaponizing finance was one of several key steps in that decline. Second example, the United States and Iran in 1979, when the Iranian Revolution erupted and American diplomats were taken hostage. President Jimmy Carter responded by freezing all Iranian assets in U.S. banks. Billions of dollars were suddenly locked with the stroke of a pen. Again, tactically, it put serious pressure on Iran, but for oil exporting states and rising economies around the world, it raised a chilling possibility. Your sovereign reserves in New York might not really be sovereign. They could be frozen overnight if your government fell out of favor with Washington. Through the 1980s and 1990s, many countries, especially in OPEC, began slowly diversifying reserves into other currencies and into gold. The dollar remained dominant, but the seeds of doubt were planted. Third example, the United States and Russia in 2014. When Russia annexed Crimea, the U.S. and EU responded with sanctions, restrictions on Russian banks and individuals, limits on financing, pressure on certain industries. But they stopped short of cutting Russia off from SWIFT. That turned out to be a critical decision because from 2014 onward, Russia behaved like a country that knew what was coming. It aggressively reduced its holdings of U.S. Treasuries. It doubled its gold reserves. It built SPFS, its own domestic financial messaging system, as a backup to SWIFT. It negotiated energy and trade deals with China, India, and others that could be settled in rubles, yuan, or rupees instead of dollars. And its leadership publicly stated it no longer considered dollar reserves safe, calling the U.S. use of sanctions weaponization of the currency. Western analysts mostly shrugged. Russia was seen as too integrated into the global economy to truly decouple. Then 2022 arrived. Russia Russia invaded Ukraine, the US and EU escalated to the nuclear level. Major Russian banks cut off from SWIFT, hundreds of billions of central bank reserves frozen, sweeping sanctions on individuals and sectors. The initial shock was real. The ruble fell sharply. Financial markets in Moscow froze. For a brief moment, it looked like the predictions of collapse might come true. But then the preparation of the previous 8 years kicked in. The Russian central bank jacked up interest rates to protect the currency. Moscow demanded European countries pay for gas in rubles, creating forced demand. Oil and gas exports were redirected to China, India, and other buyers at a discount, but still at high volume. Trade shifted into yuan, rubles, and other non-Western currencies. Within months, the ruble recovered. By 2023, Russia's GDP growth rate was outpacing some major European economies. Russia's long-term prospects may still be weaker than before, but the key point is this: the nuclear option did not destroy the target. Instead, it destroyed the illusion that the system was neutral. For countries like China, India, Saudi Arabia, Brazil, South Africa, Turkey, and many others, the lesson was obvious. Even if you're not an enemy today, you might become one tomorrow. A future conflict over Taiwan, a border crisis, a political dispute, anything, and your reserves, your banking links, your access to SWIFT could be used against you. So they began to hedge, and that's where the 5-stage backfire pattern shows up clearly. Stage 1, the dominant power controls the payment system. Stage 2, it weaponizes that system. Stage 3, the targets build alternatives. Stage 4, neutral countries hedge and diversify. Stage 5, the weapon loses its power. From 1970s onward, the U.S. and its allies sat at the center of SWIFT, the dollar system, and global payments. After 9/11, Washington used that system more and more aggressively, tracking terrorist financing, targeting so-called rogue states, sanctioning banks, and carving countries out of the network. By 2022, financially punishing Russia through SWIFT and reserves felt like the logical next step. The infrastructure was in place. The legal tools existed. The precedent had been set. That was Stage 2. Stage 3 was Russia's response. SPFS, yuan trade, rupee deals, crypto workarounds, and barter arrangements. Within a couple of years, a large chunk of Russian trade was being conducted without using dollars or SWIFT. Stage 4 is where we are now. Neutral and non-aligned countries quietly building their own escape routes. China has rapidly expanded CIPS, its cross-border interbank payment system, which settles trade in yuan and now connects hundreds of financial institutions across scores of countries. Saudi Arabia has signaled willingness to sell oil in yuan, not just dollars. The UAE has settled trade with India in dirhams and rupees. BRICS has expanded and is openly discussing alternative currencies and payment rails. Central banks around the world have bought gold at record levels, moving out of dollar assets that can be frozen into metal that cannot. And SWIFT? SWIFT is still huge, but no longer unchallenged. In other words, Stage 5 has already begun. The weapon is losing its monopoly. This doesn't mean the dollar disappears tomorrow or SWIFT suddenly shuts down. It means the direction of travel has changed. The world is moving from a single dominant system to a multipolar one, and the catalyst wasn't China invading anyone or a Wall Street crash or some secret conspiracy. The catalyst was the public visible weaponization of SWIFT and dollar reserves in 2022. So who wins and who loses in this transition? China is the obvious winner. It has the world's second largest economy, the largest manufacturing base, the largest trade volume, and an increasingly sophisticated financial infrastructure. As more trade settles in yuan, as CIPS grows, and as Belt and Road partners deepen ties, China quietly steps into the role of alternative hub. Russia gains strategically too. Its economy is much smaller, but by surviving the SWIFT cutoff and sanctions, it proved a crucial point. The U.S. financial system is powerful, but not absolute. You can be cut off and still function if you prepare and if you have partners. BRICS and the wider global South gain leverage. They are no longer locked into a single system. They can balance the U.S., China, and Europe, playing them off for better terms. They get more room to maneuver, more independence in foreign policy, and more options in crisis. Gold wins. When trust in fiat promises weakens, hard assets become more attractive. Central banks don't buy gold because they're conspiracy theorists. They buy it because gold can't be frozen with a signature in Washington or Brussels. Alternative payment systems win. CIPS, SPFS, regional networks, local currency settlement, even certain crypto rails, anything that allows governments and corporations to move value outside SWIFT, and the dollar system gains importance. Who loses? The United States loses its unique financial hegemony, not its economy, not its wealth, not its innovation, but its ability to run enormous deficits, sanction countries at will, and rely on endless demand for treasuries simply because the dollar is the world's default. Europe loses along with it because the EU chose to align completely with U.S. sanctions and the SWIFT cutoff. The euro could have been developed as a true alternative reserve, but Europe has largely followed Washington's lead instead of carving out an independent path. SWIFT itself becomes one network among several instead of the network. Its scale remains, but its exclusivity is gone, and ordinary Americans lose something intangible but massive: the exorbitant privilege of having the world's dominant reserve currency. For decades, the U.S. has been able to import more than it exports and pay for the difference with its own paper. As demand for dollars and treasuries falls, that privilege fades. Borrowing becomes more expensive. Budget deficits matter more. The standard of living that depends on cheap imported goods and easy credit becomes harder to sustain. None of this happens overnight, but the direction is set. In 1914, Britain thought it was punishing Germany by freezing assets. 30 years later, it was handing the financial crown to the United States. In 2022, the U.S. thought it was delivering a decisive blow to Russia by freezing reserves and cutting banks off SWIFT. In reality, it signaled to half the planet that the dollar system is not neutral infrastructure. It's a weapon. And once a system is seen as a weapon, everyone starts looking for armor. Financial weapons always look powerful the first time they're used, but they can only be used a few times before their very use forces the rest of the world to build alternatives. That's what's happening right now. The SWIFT cutoff didn't just punish Russia. It pushed dozens of countries to quietly prepare for a future where they never again want to be at the mercy of a single country's financial system. The dollar will likely remain important. The United States will remain a major power, but the era of unquestioned dollar SWIFT hegemony is ending, not because a rival overthrew it, but because the owner of the system chose to weaponize it, and in doing so, taught the world how to live without it.